Now, one solution that the Japanese have that we don't, and it doesn't solve the whole problem, but it's a start, is they could sell their 1.3 trillion of US treasuries. Because if they did that, then they could take the dollars they get, sell them, get Japanese yen. That'll push up the value of the yen, which will help bring down prices, especially for imports. Then the Japanese government could take those yen and buy back JGBs from the Bank of Japan, basically retire that debt. And then the Bank of Japan takes that money out of circulation. And so the Japanese money supply shrinks, and 13% of the Japanese national debt gets eliminated. Now that would fight inflation. And that would come at low political costs in Japan, because instead of asking the Japanese to pay to fight inflation, they would be asking Americans. Because one of the reasons that the Japanese own so many US treasuries is because they wanted to prop up the dollar. They didn't want the yen to get too strong because they wanted to maintain their exports to the United States. Well, we've just had a huge crash in the value of the yen. They need a stronger yen if they want lower inflation.
Well, first of all, I don't think we're approaching double-digit inflation. I think we're already there. I think that if the government was still reporting inflation the way they reported it in the 1970s, using the same methodology to calculate the CPI, the month-over-month number that we just got, which went from 9.1 to 8.5, I think it would be well north of 15%.
Wow,
so
15. Wow.
Yeah, if we kept score. Remember, back in the 1970s, they didn't use owner's equivalent rent. They used home prices. They used actual rent. Well, year over year, those things are up 15 to 20%, whereas owner's equivalent rent is up like 5.5%. That's a third of the CPI right there. That is dramatically undercounting the cost of shelter. But we also have things like substitution that we didn't have back then. Back in the 70s, the basket never changed. Now, they just keep changing the basket. They take out stuff that went up and they put in stuff that didn't go up as much. So the whole thing is manipulated. So we have double-digit inflation. We're just not being honestly told that we have it. But you go back to those gas lines of the 1970s, that wasn't the result of inflation. Higher gas prices were the result of inflation. The lines and the shortages were the result of price controls and stuff like that, which the government may in fact implement again. But Americans have been living with inflation for over a decade. It's just that the inflation didn't show up in a dramatic way on consumer prices until more recently.
So what they need to do is take our inflation that they imported and export it back to the United States. So the problem, of course, for America is that this solution for Japan just makes our problem even worse. Now, are they going to rush out and sell all of their 1.3 trillion in treasuries right away? No, but they're not going to buy any more. That's for damn sure. And I think they're already selling. And I think they're going to pick up the pace of selling treasuries because it is the most politically viable way to begin the inflation fight. Now, I don't know that they can win the fight just by selling U.S. treasuries, but it's the best way that they can start, and they can't win a fight unless they get in the ring. And the best way to do that is, again, selling dollars, selling treasuries. But when Japan throws that punch, it's the U.S. economy that gets knocked out. But even before Japan becomes a significant seller of U.S. treasuries, the Bank of Japan has now joined the tightening party, having been the last holdout from that party. And this is going to further complicate the U.S. stock market and the U.S. bond market because Japanese liquidity, which has been helping to prop up global markets, is now being withdrawn, and any assets that have been floating on that liquidity are going to sink.
Well, Powell said that the consumer would be in for the most amount of pain if the Fed failed to act and let inflation run out of control. Well, I got news for the consumer. Inflation is already out of control. The Fed failed to act. In fact, the actions of the Fed created the inflation, and it's going to get a lot worse. And Powell is looking at wages rising and thinks that that might push up inflation. No, rising wages don't cause inflation. Inflation is what's causing wages to rise. Wages are just the price of labor, and prices are going up. And eventually, the Fed is going to stop fighting inflation when the recession gets much worse, and in fact, when it becomes a financial crisis.
Quantitative easing is inflation. It's just inflation by another name. And inflation ultimately causes prices to rise. But temporarily, what happened was a lot of that inflation went into financial assets, went into stocks, bonds, real estate, stuff like that. Now it's migrated into consumer goods, and it is there to stay. The only problem is that there was a long lag between all the inflation that was created and the impact on consumer prices. Well, now we've arrived at that impact. There's so much inflation in the pipeline that nothing the Fed is doing now is going to turn off that spigot. In fact, what they are doing now is completely inadequate for the task at hand, because the only way to get rid of 8% inflation is to have interest rates that are above 8%. You need positive real interest rates so that you change consumer behavior. We need less spending and more savings. Well, no one is going to save more if you still have negative interest rates. If interest rates in a bank account are 1%, and if you can only get 2 or 3% on longer term treasuries, why would you do that when inflation is destroying the value of your purchasing power by 8% a year? No, you're going to spend everything you've got. And if we encourage more spending, well, that's more inflation. And of course, the root cause of all the money printing is the massive federal budget deficits, which are continuing to be $2 trillion plus per year. And ultimately, that spending is not only fueling demand, but it is causing the Federal Reserve, and will cause the Federal Reserve, to have to go back to quantitative easing. Despite the fact that it's talking about shrinking its balance sheet, it's going to be expanding that balance sheet, and that is more inflation. So there is no way the Fed can actually succeed in fighting inflation unless it allows interest rates to rise above the rate of inflation and forces the US government to slash government spending. None of those things is going to happen. And so the inflation problem is going to get worse.
I mean, you're always going to see an ebb and flow, but in order to really fight inflation, we would not only need much higher rates than the rates we have right now, because rates need to be enough above inflation. Well, I think you have to continue to recognize that the game has changed. We're going to be living in a high inflation environment for the foreseeable future. Rates are not going back down to zero, but they're still going to be negative in real terms. And you have to invest in real businesses that actually have earnings and pay dividends.